Maya was 27 years old, a middle school teacher with $3,000 saved up and a genuine desire to start investing. But every time she opened her brokerage app and saw those jagged lines, colorful bars, and scrolling numbers, she immediately closed it. She told herself, "That's for Wall Street people, not me." Sound familiar? Here's what changed everything for Maya, and what we're going to cover today. By the end of this video, you'll be able to look at any basic stock chart and actually understand what you're seeing. Before we dive into the details, let's answer the most basic question. What is a stock chart? Simply put, it's a picture of a stock's price history over time. The horizontal axis, the bottom of the chart, shows time. The vertical axis on the side shows price. That's really the foundation. Maya's first breakthrough was realizing that a chart isn't a magic prediction machine. It's just a visual record of what buyers and sellers agreed a stock was worth at any given moment. Once she understood that, the chart stopped feeling like a foreign language and started making sense. Now let's talk about the most common chart type you'll see, the candlestick chart. Each little shape on the chart is called a candle, and each candle represents one time period, one day, 1 week, or even 1 hour, depending on how you set it. A green candle means the price closed higher than it opened. The stock went up. A red candle means it closed lower. The stock went down. Those thin lines poking above and below the candle body, those are called wicks, and they show the highest and lowest price reached during that period. This is exactly the chart type Maya was staring at. And once she learned to read these candles, the chart immediately came alive. Here's a real-world example. This is the S&P 500, the index that tracks 500 of America's largest companies over the last 5 years. When Maya first saw a chart like this, she only noticed the scary dips. But here's what a more experienced eye sees: a general upward trend with temporary pullbacks. The dips? Those are short-term noise. The overall direction? That's the signal. This is why most long-term investors don't panic during downturns. They've learned to read the big picture. According to historical data, the S&P 500 has returned roughly 10% annually on average over the long run. Here's where it gets really useful. On most charts, you'll see one or two smooth lines running through the jagged price action. Those are called moving averages, and they're one of the most widely used tools in investing. A moving average simply takes the average closing price over a set number of days. The 50-day moving average shows short-term momentum. The 200-day moving average shows the bigger, longer-term trend. Maya's aha moment came when she noticed that every time a stock's price crossed above its 200-day moving average, it often marked the start of a stronger run. That doesn't mean it always happens, but it's a data point worth watching. At the bottom of almost every stock chart, you'll see a row of vertical bars. Most beginners ignore them completely. Maya did too at first. Those bars represent volume, the number of shares traded in a given period. Volume is like the volume knob on your TV. A big price move on low volume? That's a whisper, hard to trust. A big price move on high volume? That's a shout. The market means business. When Maya saw a stock she was watching spike 8% on 3 times its normal volume, she understood that real buyers were moving in, not just noise. Volume confirms the story the price is telling. Let's look at this visually. This chart shows a hypothetical stock over 12 weeks, tracking both price movement and volume side by side. Notice how the biggest price moves, both up and down, align almost perfectly with the tallest volume bars. The weeks where price barely moved, volume was low. This pattern is incredibly consistent across markets. It's one of the first things Maya started checking before making any decision. As always, This is for educational purposes. Past patterns in individual charts don't guarantee future results, and all investments carry risk. Two of the most powerful concepts on any chart are support and resistance. Support is a price level where a stock tends to stop falling. Think of it as a floor. Buyers keep showing up at that price. Resistance is the opposite, a ceiling where sellers keep pushing the price back down. When Maya looked at a chart of a company she was researching, she noticed the stock had bounced off the same price 3 times over 6 months. That was support. And she noticed it kept hitting the same upper price and pulling back. That was resistance. When a stock finally breaks through resistance on high volume, that often signals the start of a new move higher. These zones are one of the most practical tools any investor can use. Here's a number that might surprise you. According to the FINRA Investor Education Foundation, roughly 71% of retail investors who use even basic chart analysis report feeling significantly more confident in their investment decisions. That's huge. Not because charts predict the future, they don't, but because understanding a chart means you're making decisions based on actual data instead of emotion. Maya told me that once she could read a chart, she stopped panic selling every time the market dipped. That shift in confidence is worth everything when it comes to long-term investing. Let's put it all together with a simple 4-step process, the same one Maya uses now every time she looks at a chart. First, zoom out and identify the overall trend. Is the price generally going up, down, or sideways? Second, check the moving averages. Is the price trading above or below the 50 and 200-day lines? Third, look at volume on any significant price moves. Is it confirmed or just noise? Fourth, identify key support and resistance zones to understand where the price might find a floor or a ceiling. You don't need all of this to be perfect. Even applying 2 or 3 of these steps puts you ahead of most casual investors. Maya went from closing her brokerage app out of fear to spending 20 minutes each week reviewing charts on her watch list. She hasn't become a day trader. That's not the goal. She's a long-term investor who now understands what she's looking at. Today, she has $3,000 invested across 3 index funds, and she checks in on them calmly, using exactly the 4 concepts we covered today. Here are your key takeaways. Candlesticks show you price action in one period. Moving averages reveal the underlying trend. Volume confirms whether a price move is meaningful, and support and resistance show where buyers and sellers historically show up. Start with these 4, and charts will never feel intimidating again. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance